This is moving even more quickly than many of us anticipated it would for weeks. I've been warning my viewers about the escalating banking crisis. Because when banks run into trouble, they become really tight with their money, which results in fewer mortgages, commercial real estate loans, auto loans, and credit cards being issued. Therefore, the fact that US banks are currently losing deposits at an absolutely alarming rate during the week ending March 15 should deeply worry all of us. Although $98.4 billion were taken out of American banks, which was a terrible amount, we recently found that the situation worsened the next week, during the week of March 22, when $126 billion were taken out of American banks. All banks face a difficult situation as a result of the deposit outflows. If they raise interest rates on deposits to retain customers, this could reduce their profitability. However, if they lose too many customers, as Silicon Valley Bank did, they risk losing vital funding and may need to sell off assets at a loss to cover withdrawals. Customers at Silicon Valley Bank withdrew $42 billion in a single day, leaving the bank with a negative cash balance of $958 million. If this trend continues, banks may be forced to sell assets to raise cash, but US banks are currently sitting on a giant mountain of unrealized losses. A study published on March 13 looked more closely at the unrealized losses. Bank security holdings were likely worth $780 billion, not $620 billion as the FDIC had calculated. However, the authors went further, correctly noting that loans, like securities, also lose value as interest rates rise. They discovered that the total unrealized losses as of December 2022 were $1.7 trillion. In a chilling warning, the authors noted that the losses from the interest rate increase are comparable to the total equal in the entire banking system. Unfortunately, I was mistaken in thinking that the credit crunch wouldn't really intensify for some time. We have never seen bank lending shrink faster than it did during the second half of March. Wow, and it turns out that small banks are getting particularly really tight with their money. In fact, it has been reported that during the last 2 weeks of March, bank lending in the United States decreased by the most on record, indicating a tightening of credit conditions in the wake of several high-profile bank collapses that risk harming the economy. The recent week's dip of more than $45 billion was mostly caused by a decline in loans from small banks. Less money was borrowed overall in the second half of March, with commercial and industrial loans and real estate loans both declining. The decline in lending comes after a number of businesses, including Silicon Valley Bank and Signature Bank, went bankrupt. According to JP Morgan Chase, the banking crisis has increased the likelihood of a recession because Jamie Dimon, the bank's CEO, stated in an annual letter that the failures have caused significant market trepidation and will undoubtedly result in some tightening of financial conditions as banks and other lenders become more cautious. Nearly 3/4 of domestic banking is handled by the largest 25 domestic banks, however smaller banks play a significant role as credit providers in several major sectors, such as commercial real estate. Commercial real estate prices are already falling, and now Morgan Stanley is stating that the eventual decline may match the decline seen during the 2008 financial crisis. Investors have increased their attention on this sector given regional banks' sizable share in commercial real estate lending even before the banking industry's turmoil. However, the sector is currently dealing with a significant refinancing war as more than half of the $2.9 trillion in commercial mortgages will be up for refinancing in the coming years. Even if rates remain unchanged, many of CRE's existing mortgages will have new lending rates that are 3.5 to 4.5 percentage points higher. Commercial real estate prices have already started to decline, and Morgan Stanley analysts expect prices to rise by up to 40%. Comparable to the drop experienced during the 2008 financial crisis, these types of difficulties can harm entire business communities connected to the real estate sector as well as the industry itself. Many people believed I was exaggerating when I said that the commercial real estate crisis we are about to enter is the greatest in our history. I wasn't exaggerating at all, but the credit crunch we're currently experiencing will undoubtedly have a significant impact on the entire economy. When consumers have access to less credit, they spend less, and when consumers spend less, businesses generate less revenue, which leads to the hiring of fewer workers. When workers are laid off, they fall behind on their debts, which puts even more pressure on the banks. This new credit crisis threatens to spiral out of control. James Bullard appears to be adamant that interest rates should increase. It's a good time to continue fighting inflation and try to get on that disinflationary path since, at least temporarily, financial stress seems to have subsided, according to Bullard, who said Thursday after attending an event in Little Rock, Arkansas. Fed in St. Louis. Since demand for loans is still high despite tighter financial conditions, Chief said he doesn't believe tighter credit restrictions brought on by the recent banking turbulence would be significant enough to send the U.S. economy into recession. According to Bullard, the level of stress is lower than it was during the 2007 to 2009 financial crisis. He claimed that the Fed's efforts to ease financial stress by establishing a new lending facility for banks look to be succeeding. Financial stress can be mitigated through prudential policies, although effective monetary policy can continue to drive inflation downward. Bullard stated at an event sponsored by the Arkansas State Bank Department that officials increased interest rates by a 1/4 percentage point last month to maintain their aggressive year-long campaign to reduce prices of precious metals despite financial stability concerns in the wake of the second-largest banking collapse in U.S. history. This brought their policy benchmark to a target range of 4.75% to 5%, up from near zero. The demand for loans may be strong, but the supply of credit is starting to dry up really quickly. Meanwhile, Americans continue to withdraw money from the banks at an astounding rate. 4 CARs released at the same time last year showed the 18 officials expected rates to reach 5.1% by year's end according to their median projection. The report released on Friday also revealed that commercial bank deposits fell by $64.7 billion in the most recent week, the 10th consecutive week of declines, primarily due to a dip at big businesses. Bank economists surveyed by the American Bankers Association predict that credit conditions will continue to tighten in the months to come. The headline credit index dropped in the second quarter to 5.8, dropping 6.7 points to its lowest level since the start of the pandemic. The reading shows that bank economists generally anticipate weaker credit market conditions over the next 6 months, and banks are expected to become more cautious when granting credit. Bank economists surveyed by the American Bankers Association predict that credit conditions will continue to tighten in the months to come. The headline credit index dropped in the second quarter to 5.8, dropping 6.7 points to its lowest level since the start of the pandemic. The reading shows that bank economists generally anticipate weaker credit market conditions over the next 6 months, and banks are expected to become more cautious when granting credit. Take a look at those figures. Any number below 50 is undesirable, and those figures are currently in the single digits. A staggering 72% of all Americans think that the economy is deteriorating. According to a recent survey, 83% of American people think the country's economic situation is only fair or poor. Additionally, according to Gallup, 72% of people believe that the economy is growing worse. Unfortunately, most people are unaware that this is only the tip of the iceberg because bubbles have already started to form and our entire system is starting to quiver violently. In light of the enormous credit crisis that is currently in place and the fact that most Americans are unaware that serious economic suffering is imminent, I would urge you to hold on tight and I would want to thank you for watching.